Welcome back to this tutorial on financial modeling using Kaluta projection methodology. Last time we ended up doing the business valuation using a business unlevered free cash flow. And we computed valuation metrics which are the present value of the cash flow, net present value, internal rate of return, profitability index, and payback period. So those were our metrics that were computed, and we said that these metrics are not plausible because they are out of sync with the normal or expected business pattern. Okay, they are too huge. So we say either we have underestimated the costs or we have overestimated the sales. Okay, now if this business is located in a country where you can get industry data relating to that business, then you can prepare common size financial statements. For example, if it is profit and loss statement, you express all the line items as percentage of sales, okay, to derive the percentage of each component, each line item within the profit and loss statement. Okay, so for cash you can use either net cash flow, or you can use for all items within the cash flow, or you can use cash flow from operation. The total of cash flow from operation can be used as a denominator for all the cash items falling under cash flow from operations. And investing activity, the total from cash flow from investing activity can be used as a denominator for all investing activity in all related investing activities related transactions. Okay, and for financing the same, you take the total financing figure and then you use it as denominator to establish the percentage for line items in financing. Okay, so once you have a common size, you can detect which percentage. For example, if we are talking about, let me go to P&L here sheet. So if salaries and wages percentage wise is less or greater than the industry, then we could know that we have overestimated or underestimated the sales figure. The same for any other item. And even, for example, the depreciation can tell us about the potential for overestimating or underestimating the assets that are needed for this business. Okay, so that way we could correct and rectify the situation. But with my experience dealing with the clients, normally when we arrive at this stage, they normally will be able to locate which area there is either overestimation or underestimation, or if there is, oftentimes it is because a certain line item has been forgotten. Maybe it's an expense or it's an asset was not taken into consideration when we were doing our projections. So we correct that and things and the matrix becomes plausible. Okay, so I will do that exercise of common size financial statements in another tutorial. This is just to show you what are the ways, the ways you can use to detect a normal pattern within your projected numbers and rectify it. Okay, so let us now assume, let's go to the working sheets here. So let us assume that our projected sales quantity was overestimated. Okay, so for the first, in April we say it's 12. In May, maybe instead of saying 30, let's say it is 15, sorry. We need to and also this one. So say it's 15, and here instead of 50 in June, let's say it is 30, and from here instead of 80 is 50, and here is where we said that we 50, and yeah, so here is where we said that in July we arrived at a steady state. So throughout the projection period, the quantity is now going to be 50. Okay, so after doing that adjustment of our expected sales, let us now see what are our numbers, our business valuation metrics in this annual cash flow sheet. So present value, NPV, IRR is still great. This one is still too great. So let us go and reduce further workings here. Let us just assume the problem was in sales here. So 12, 15 instead of 30, let's do it. Instead of 30, let us do it to be 20. Instead of 50, let us do it be 30. And here, so 30 is the steady state. Let's see what that one will give us in terms of our valuation metrics. Okay, now it's at least plausible, because you can see the IRR now is 65%. Okay, so at least these are plausible business valuation metrics. Now we can proceed. So as we said, this business has NPV, positive NPV. Okay, and if the business has positive NPV, then that business is worth. Why? Because our future cash flows here have been discounted using cost of capital, okay, as the time value of money, because that is an opportunity cost. You could, if you have the present, if your future, if you discount your future cash flow and bring it now, then that money which is now can be invested with your cost of capital to determine that future cash flow. So by discounting them, and the present value of discounted cash flow becomes greater than the initial cash outlay, then that means that it's profitable to do that business, because the intrinsic value of the business is greater than if you could have just because if the present value of all future cash flow were equal to initial outlay, that means the NPV would have been 0, and that would be the case where the cost of capital now is balanced. Okay, that means you don't have any loss, it is balanced. Okay, but if you have a positive cash outflow, then that means you have more than what your cost of capital requires you to get, so that is positive. Okay, so that's for NPV. IRR, as we said, this is an internal rate of return, and when it is greater than the cost of capital, and this case is this weighted average cost of capital, then it is plausible. Okay, that means the business is generating more, the internal rate of the business is more than what is required to compensate the providers of funds, that is the cost of capital. Okay, so for profitability index, okay, this one we said we have taken all the discounted cash flows at the present value and then divide by initial outlay to establish how our future cash flow, present value of our future cash flow, has how many multiples compared to initial cash outlay. Okay, so the greater the number, if it is 1, that means all the business is at break even, which means the expected future cash flow is exactly the same with initial outlay, so it's break even. Okay, no profit, no loss for the business. So any profitability index greater than 1 indicates that the business is profitable, or plausible, or viable for that matter. For the payback period, the same. Okay, for the payback period is the same, and this one you compare, you see this is also the break-even. I mean, we have put the present value of the cash flow as a calculation. Present value of a cash flow, we have accumulated it. So when the present value of the cash flow exceeds, becomes positive, the accumulate becomes positive, then that is where there is a break-even point between the negative cumulative cash flow and the positive, and that break-even point is established through extrapolation. Okay, we did it manually previously just to show you how the extrapolation is done. Now in this exercise we will do it using the Excel formula. So after doing that, now let us proceed with other things. We established our NPV manually, I can say, by using the discount factor, and then we discounted the future cash flow to bring them at the present value, and then we less the initial outlay to establish the present value. Okay, so we sum the present value of all free cash flows of the business. Okay, the other way to do that would be to use a net present value formula of Excel. Okay, so let me just put it here and start with equal sign, then write NPV. In this case, we are taking the future, the present value of, we are discounting the future cash flows. So here from unlevered free cash flow here on top. So from here, the future cash flow starts from year 1 here. So this is the up to year 3. This is the cash flow now, which we are discounting it to bring out the present value. Okay, so the formula for Excel will cover that. We don't include initial outlay because this is already value now, so it does not need to be discounted. Okay, so after discounting the future, then we can just minus this initial outlay to arrive at the NPV using Excel formula. So maybe to make it easier, let's first establish the NPV of future cash flows first. Okay, sorry, let me repeat it again. So we start with equal sign, equal sign, and then NPV. And when I use this, you see I need to put rate first, as the formula indicates on the formula bar there. So I need to put rate first, and our rate is this weighted average cost of capital. So I click on the rate and then put comma and then pick the range of unlevered free cash flow from year 1 here up to the end of our projection period, and in this case is year 3. Then that's the figure for. Okay, it is in dollar sign. Let me remove this by formatting it here. Use this one and then remove the decimal places, and then okay, yeah, so that is enough. Now we have discounted the future cash flows. Now we need to minus the initial outlay. So at the end of the formula there, I put minus, because the initial outlay is negative number already. So instead of using minus, just plus initial figure here, which is this one. Press enter. Okay, so you can see our manual calculation is exactly the same as our calculation using NPV formula with Excel. Just remember that don't include initial outlay when you use NPV. Just discount the future cash flow, because initial outlay is already now, so it doesn't need to be discounted. Okay, so that is it for formula. And the rest, IRR, profitability index, payback period, we did it manually, so we can now use a formula. Because we did this manually before. So you see the payback period is still that old one. Okay, it's not corrected already. So now I need to put a formula here. Okay, so let me delete this first, and payback period here. Let us also delete this, clear this. Now I'll put the formula from year 1. I'll put the formula from year 2 here, because here is where there is a break even between year 1 where we have a negative cumulative negative PV, and year 2 where we have positive PV. So I'm going to put a formula here by starting with equal sign, and they say if, and then this one put a bracket, and then say and then bracket. So if this figure here, cumulative cash flow, is greater than 0, comma, and this figure here is less than 0, okay, so that is, I close the bracket. So if this previous figure is negative and the current figure of cumulative PP is positive, then what we do now is to interpolate. So I put comma there, and then I click on the year figure of the previous period here, which is 1, and then okay, let me start with bracket first. So I take this 1 plus, I then use bracket again, and I interpolate now by starting with negative, this negative cumulative figure, to change it to positive, divide by the PV here on top, the PV, okay, so that is the extrapolation now. So we have already extrapolated that, and then what is needed now is to close the bracket, and another bracket needs to be closed here, because the two brackets are for extrapolation process, and so we have used another bracket here. So we say if both of these situations happen, that you have negative PV and negative cumulative PV and positive cumulative PV, then take the previous year and extrapolate, okay. Otherwise, that means, so I put comma here, otherwise that means if they are not both positive and negative, then don't fill anything there. So let me use this one, double tap here, okay, and then close the bracket. So let us look at the formula bar and count the brackets to the left and to the right. They must balance. So to the left we have 1, 2, 3, 4, and to the right we have 1, 2, 3, 4. So they have balanced. So check OK. Okay. So this formula is going to be true throughout our extrapolation period. So I tap to copy this. I copy this and then copy it from here. Just select all this up to the year end and then paste the formula. Okay. So after doing that, then our payback period is simply put the formula here. Start with equal sign, and there is you say sum, open the bracket, we just sum from here to the end of our projection period. So wherever it will fall, that is going to be our payback period. Okay, so this is how we establish our payback period, by using Excel formula. This was the previous one to express the figure in terms of months, because it was less than 1 year, so we don't need this. I just remove this. Clear? Okay, so now we have rectified our numbers, and but there is one thing here. We are not our figures are not correct. Why? Because let us come to profit and loss sheet here, monthly profit and loss sheet. After doing adjustment for the sales figure, our net profit has now changed. Okay, so we need to recompute our tax because we did it manually. Okay, so as you can see here, we still have cumulative loss up to after adjustments of our projected sales. So the cumulative loss figure is coming up to May. So all this period we do not compute tax, because we will have to pay tax after we have absorbed all the losses, cumulative losses. Okay, so I need to delete now this tax figure here, which we did, so that we do other computations. Okay, so I clear this. Now manually, that means I will have now to come to a point where our cumulative is exhausted here, so the tax will start to be computed from here. Okay, but doing it manually, you see there is a problem that you have to, whenever you do changes, you need to come and adjust first manually for your tax figure before you can proceed. Otherwise you'll have wrong tax computation. So to solve this problem, we can use a formula here, so long as once this formula is applicable, so long as once you have exhausted the cumulative net loss, you will not have the cumulative loss again. And this is normal business pattern for many projections. So the formula may be applicable in most situations. Okay, but you need to be careful. If the project develops some losses in the future, the formula will not be applicable. Then to develop the formula, instead of doing manually here, let me start with profit before tax figure, so which is here. Press enter, and then here we will have cumulative, For the first month, it's just this one, and let me take this, tap this to fill this in the next month here, because it is the same. But for cumulative, now it is previous month plus current month. This is cumulative figure. Press enter, and then I can copy this and drag this throughout, fill this throughout the projected period. Okay, now we need to establish what is taxable income. Taxable income, and in this case it will start all this period here. We don't have taxable income because there were cumulative losses. Okay, so taxable income starts from here. Okay, so I can put a formula here, start with equal sign, and say if, open the bracket, this cumulative figure here is greater than 1, so greater than 0, put comma, and start with if again. If, open the bracket, this previous figure here is less than 0, then the taxable income will be this cumulative figure here. Okay, otherwise the taxable income, otherwise that means if this one is positive here, the previous figure is positive, then the taxable income will be PBT, the figure before, I mean profit before tax. That is going to be so if he, otherwise, okay, so here I close the bracket and then put comma. Now we have started with if ends at 8 is greater than 0. Okay, this figure. Now if this one is less than 0, then there will be no taxable income. So I end my syntax by put 0, and then close the bracket, and then count to left bracket. We have 1, 2, and right brackets 1, 2. Okay, so enter. Okay, so this formula is true throughout, so I copy this and apply it from the beginning here to the end of our projection period. Oh, something is not, I wanted to, okay, I copied this one where we calculated it here. Okay, so after selecting, I was supposed to paste, because it's still, the copy function is still active. So after selecting all this, I need to paste here. Okay, So we see, so you can see the logic here. In soon after exhausting the cumulative loss, the taxable income is not going to be profit before tax, but is going to be profit before tax minus cumulative loss in the previous, and you remain with net. This is what you are going to charge tax. But after you have exhausted your cumulative losses, then the taxable income is going to be profit before tax figure here, because you don't have cumulative loss to reduce. So that is the logic of this formula to establish taxable income. You can simply, because you will have this Excel sheet to download if you are interested to learn about these formulas yourself, so you will be able to simply use the formula instead of minding about how are you going to do it yourself as I'm doing here, right? So after establishing your taxable income, you now compute the tax, which is simply taxable income multiplied by tax rate, and our tax rate is 30%, corporate tax rate. So I tap to fill this throughout our projection period, because it is true. And after doing that, then I just come here in the profit and loss, start with equal sign, and then pick the figure for tax. Okay, here, press enter, and then I drag this one, tap to fill. Oh, what is this? Want to tap to fill this. Why is it does not? Oh, that's the problem of dealing with the tablet Android. I just want to copy this formula throughout. When I tap so that I open the local menu, it does not agree. Sorry guys, I need to finish this. There is no way unless I finish this. And okay. Now I've failed this. Okay. I was struggling here. This is just what I wanted to do, to fill this throughout our projection period. A lot of time has been consumed for nothing. So we have our tax figures, and on monthly basis, already incorporated in our income statement. And as you can see, the tax figure started after we have paid for all the cumulative losses here, and these have already been incorporated into, for example, in a monthly cash flow statement here. Already we have incorporated the tax component, so it's already picked from profit and loss statements. From the workings, there is a place for working for tax, where we assume that the tax are paid on quarterly basis. So the cash flow for tax here is happening on quarterly basis. So it's also captured here. And in the balance sheet, of course, because it is paid, we accrued monthly and is paid on quarterly basis, we have tax payable figure in our monthly balance sheet. Our monthly balance sheet here, there are current liabilities. Those files under accruals. I have just put all the accruals under one place. Okay, so now let us come back to our valuation after doing all those adjustments. But there is also one thing here in the annual cash flow sheet. Here, we did annual profit and loss here. We did a computation of theoretical tax. Okay, we started with profit before tax, and then we added back interest component because we wanted to derive the unlevered free cash flow, so we had to add back the interest component, and then we got our adjusted profit before tax, and then after that we did computation of theoretical tax. But because we made these summaries on annual, there is no problem here, because adjusted profit before tax in year 0 is that one, and in year 1 we have +1. So our theoretical tax here is not affected, which has taken it has taken the positive profit before tax minus the cumulative loss times 30 for the first, and after that this was manual accounting, so this one is okay. We don't need to put a formula here. Of course, you know now how to develop that, to put the formula that will automate the process, but manually here is still correct. So after we are now satisfied of all the computations to be correct, let us go back to our annual cash flow and see the valuation. Yeah, they are still plausible. Our weighted average cost of capital, that one. Our net present value, that one. Our IRR is that one. Payback period. So it's plausible. There were no much effect on the tax adjustments. Okay, so far we have used the conventional cash flow that is used for the purpose of computation of these discounted cash flows, NPV, IRR. Okay, with this cash flow, these computations assume that the cash flow, the timing of the cash flow is periodic, okay? And in this case, our period is 1 year period. We have year 0, year 1. From year 0 to year 1, there is a 12-month period. From year 1 to year 2, 12-month period, according to what we did, okay? For us, year 0, if we go to, say, let's go to monthly cash flow figure here. So year 0, we took it to be January up to March, where our business was at pre-operating period, okay, setup period. We have not yet started to generate sales, okay. So this was the setup or pre-operating period, and this one is the period we defined to be year 0, okay. So the NPV and ARR formula, they assume that the cash flow is periodic, and for periodic here we mean annually. The way we did our computations were on annual basis, okay. That's why we use also weighted average cost of capital, which was an annual rate, okay. So year 0 was this period from January to March, okay. And after year 0, year 1 started from April and ended at March, okay. So you can see the end period of year 0 is exactly the same as the end period of year 1, year 2, which was in March. So year 1, you see March here. Year 2 starts from here, April, goes up to March, okay. And for that matter now, okay, year 2, it goes up to March, okay, year 3 and so on. So for that matter, our periodic timing is the same for the period of 12 months from one period to the other. And then another assumption that is used in these computations of NPV IRR is that the cash is, the timing for the cash flow is at the end of the period, okay. So in this case, at the end of the year, and as we said, our end here is March, okay. So we have so our computations of NPV and the RR assume that this cash flow timing ends in March, which is okay. For our case here, it's okay, because first, this cash flow is evenly distributed according to this nature of the business, is evenly distributed, so there's no big impact on the timing of the actual cash flow, okay. But we still need to apply other valuation metrics that will enhance the quality of projected numbers, okay. So instead of using NPV IRR, we will use another version of NPV and IRR that take into consideration the exact timing of the cash flow. These formulas have assumed the cash flow is the timing. Cash flow timing is at the end of the period, but for NPV, for example, but if you use XNPV, then the timing of the cash flow is flexible. It depends on when it is the cash flow has been actualized, okay. For example, if I type here, say the starting period for your business is is edit is July. July 2020, and then the full year ends in December 2020, where the first future cash flow is discounted, and then December 2021 is the second year, and December 2022 is the third year, and so on. Okay, so if that is the case, you will see that for the first starting period you only have 5 months to the end of the year. Okay, so the period is not spaced exactly. Okay, here's just 5 months, while here, so from here to here is just 5 months, while from here to December 20 to December to December 2021 is 12 months. So you cannot use NPV in this case, or IRR. You need to use XNPV and XIRR. We will do that in the next lesson. For now, let us end up here, and I just want to select and delete these ones. Clear. So let us end here, guys, and let us meet in the next tutorial. Subscribe to my channel if you haven't done that yet, so that you get posted of the new contents that are going to flow for you to be aware of them. Thanks, bye for now. See you next time.